Hey traders, today is Tuesday, March 3rd, and I'm Michael Boutros, Senior Market Analyst with StoneX here for a quick multi-time frame look at the euro dollar. So we've seen continued US dollar strength amid the ongoing turmoil there in Iran, and the dollar has been catching a bid. Euro dollar is now testing a critical support zone, which may offer some serious inflection in price in the days ahead. You're looking at the January close low that comes in right around 116. It's 1597, and a break there on a closed basis would certainly open up the potential for a much larger decline. Earlier in the year, we had noted that euro came off uptrend resistance and a key resistance barrier last month. Actually, that was in January. And the pullback now testing the objective yearly close low and the yearly range lows, just a little bit lower from where we are right now. So we're looking for potential inflection here. Just want to highlight the 52-week moving average comes in right near 1560. So the ideal scenario is that you actually see a close below that to confirm the break. But certainly on a focus right now, the euro is testing support as we speak. A look at the daily chart looks like this. The 100% extension off of the high of the year converges on the objective December swing low. That entails also the low close from December. That gives you a range of 1590 into 1612. We're testing that zone right now, and we're looking for potential inflection here. If this level were to give out, there's a lot of room to the downside. The next major level comes in near 15 if this were to give way. So we're looking for potential inflection here. You need a daily close below to validate that move. Here's what it looks like on the 4-hour chart. This is the same pitchfork we've been tracking for the last couple of weeks. You can see that the upper parallel caught some resistance last week on Friday. And then this week into the open yesterday, we did break key support, which was at the objective yearly open and the 618 retracement of the year-to-date range, namely the January range. So that was also a break of the February opening range, which never gave out all the way into the close of the month and does give us a near-term downside bias. That decline is now testing support. You can also see that a basic channel line here. This is a parallel of the slope resistance off of the highs from July and September of last year. That caught the high in January. A parallel of that same slope has that converging in the same zone. So weakness below this zone would be a break of a multi-month uptrend and certainly would leave the room for further downside. Now, immediate levels would be the October swing low near 1542. And then you're looking at 1497 into 1492. That's the November low day close. And that's the March 2020 and the 2022 swing high. So a decent pivot in price. Both those levels in view if we were to mark a close below this zone. Initial resistance comes at the January low day close, and that comes in near 1645. The 200-day moving average is just above that. Bearish invalidation is now at the origin of this breakdown. Former key support, and that's the yearly open and the 618 near 1745, 1772. 1771. So we would need to see a break above this and a close above this to suggest that a more significant low is in place and potential resumption of the uptrend. That said, we're now testing downtrend support. We did get some data out of the Eurozone earlier today. CPI figures came in hotter than expected. We do have a lot of event risk still on tap. ADP employment out of the U.S. tomorrow. Retail sales from the Eurozone on Thursday. And then on Friday, we get an update on Eurozone GDP for Q4, as well as retail sales from the United States and the non-farm payroll report, which will be critical. As it stands, the dollar has been pushing most of this move on account of shifts in the interest rate expectations. As the war goes on, oil prices are now reaching 7-month highs, and the concern is, as I noted yesterday, that those oil prices will filter into inflation and really make the Fed more reluctant, limit scope for further rate cuts. The markets are reacting in kind. If you look at Fed fund futures for June, which was the next expected rate cut till last week, essentially, we're now pricing in a 62.4% chance that they're going to see a hold in June. And even the July read is just barely over 50%, 47% expected that we're going to see a hold even in July. So as those interest rate expectations for cuts from the Fed move out, that is offering some support for the US dollar. Aside with some minor risk off flows, the dollar remains pretty well supported. That said, Euro is now trading at a major inflection. Watch today's close. We'll try to keep you updated as always on X at MB4X. Till then, best of luck trading. We'll see you tomorrow. Cheers.